Welcome. In this video, will Xcn coin react upwards? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. The structure on the chart is a remarkable downtrend pattern. It shows that the price has been making lower highs and lower lows over a period of time. However, this should not be interpreted as a sign of persistent weakness. On the contrary, falling trend lines can be a harbinger of strong rises after possible breakouts in technical analysis. The existence of this downtrend may present a zone of opportunity for traders, because when such structures are broken, it is possible that the previously suppressed upside potential of the price can be released. In the chart we're looking at, price action has been moving in a falling channel for some time now, with the upper boundary of this channel, the resistance line, acting as the main area of price suppression. The more this trend line is tested, the more likely it is to be broken. Currently, the price is approaching this falling trend line again. Each test may indicate that the line is weakening and starting to lose its resistance characteristic. In this context, the current technical outlook looks extremely promising. If the price breaks this downtrend, it will show that the market psychology is starting to change and sellers are losing their pressure. This is because the falling trend line is also a symbol of general pessimism in the market. When this line is broken, previously hesitant traders may start buying, giving the price an additional impetus. This breakout is therefore not only a technical event, but also the breaking of a psychological barrier. In particular, a volume-backed breakout would further increase the persistence of this uptrend. Volume often represents the real power behind price movements. If there is a significant increase in volume as the price breaks the falling trend line, then the sustainability of the uptrend becomes much more likely. This gives traders more confidence and pushes the overall direction of the market upwards. When we look at the price movements that come with the breakout of similar structures in the past, it has been seen that the price reacts rapidly upwards after such downtrend breakouts. This shows that such breakouts are considered very strong signals in technical analysis. Once the price breaks above this trend line, the ground is set for a new uptrend to begin. From this point on, traders can aim for higher highs. Such downtrend breakouts can present serious opportunities not only for short-term trades, but also for medium and long-term traders. This is because a trend break is usually followed by the start of a new trend. Since this new trend will be upward, prices are expected to increase over larger time frames. This allows traders to move their positions more comfortably. However, trend breakouts often come with a retest move. This means that, after breaking the trend line, the price may test it with a short-term retracement. If this test is successful, the line now acts as a support. This transformation is also considered a very important and positive development in technical analysis. The bullish candles formed during the retest further clarify the strength and direction of the market. In line with all these developments, a strong upward rally is quite possible if the current downtrend is broken. At this point, both technical structure and market psychology move in the same direction. As the selling pressure decreases, buyers gain courage, allowing the price to accelerate towards higher levels. This means serious potential for investors. In conclusion, the current chart structure presents an extremely positive picture from a technical point of view. The falling trend line is an important resistance level, but it also represents the beginning of a new uptrend as soon as it is broken. If the price breaks above this trend line, there could be a strong upward momentum in the market. But we can't decide the analysis by trends alone. Let's look at other metrics. Stay tuned. One of the important areas that stands out on the chart is a strong reaction area. This is an area where the price has paused, changed direction, or reacted sharply to the upside many times in the past. In technical analysis, such areas are closely followed by investors, because levels that leave a mark in the market's memory often cause similar reactions in the future. At the moment, the price is positioned in exactly such a region. At this level, buyers can be expected to re-engage, and strong technical signals may occur for the start of a bullish move. Such reaction zones usually coincide with both horizontal support resistance areas and psychological levels. They may also coincide with Fibonacci retracement levels, trend lines, or necklines of past patterns. The fact that the price is in this zone means that many indicators are converging at the same point, which shows how strategic and influential this level is. Such a structure attracts traders' attention and often becomes an area where buy orders are concentrated. The price is currently in this important area, and an upside reaction from this area is technically quite possible. This is because, given the market's previous reactions, it's clear that this level serves as a turning point. In the past, when the price reached this point, it jumped up sharply and gained a strong bullish momentum. The conditions for the same scenario to happen again seem to be largely in place. This area could also be the last bastion to prevent the price from falling lower. Such structures function as market stabilizers. If there is a reaction from here, it could not only end the current decline, but could also be the start of a new uptrend. Therefore, an upside breakout or rise from this level will be a confidence-boosting development for investors and will lead to the opening of new buying positions in the market. In addition, the increase in volume in this region can also be considered as an important technical indicator, because the increase in volume in the reaction zones is a reflection of the buyer interest there. In other words, if the volume increases at the same time when the price starts bouncing up from this zone, this indicates that the uptrend is based on more solid fundamentals, and market participants are taking this turn seriously. Such a scenario is one of the most favorable prospects of technical analysis. Upward breakouts from the reaction zones can often turn into a rally. Especially at such levels, pattern triggers are also possible. For example, a double bottom pattern, an inverse shoulder head and shoulders pattern, or a rising wedge can form at such turning points. These patterns provide important grounds not only for short-term targets, but also for medium and long-term potentials. This increases investors' expectations and reinforces confidence in the market. A possible reaction from this area may cause the price to rise quickly to the next resistance level. Because at such critical levels, stop-loss orders and buy orders are concentrated. When the price breaks up, sellers with stop losses exit the market, while buy positions gain volume, putting upward pressure on the price. This pushes the price upwards not only technically, but also in terms of market dynamics. Such levels are also carefully watched by large investors, whales, or institutional traders, because such players analyze the market structure and liquidity points well. Therefore, their positioning in such a reaction zone may cause the price to move upwards more strongly and decisively. This is an extremely important signal for ordinary traders to follow. The Relative Strength Index, RSI, is a powerful technical analysis tool for determining market direction. The current chart shows that the RSI has formed a falling trend structure that has been tested several times over time, with a clear downward bias. This falling structure is in the form of a resistance line connecting the RSI's peaks and usually indicates that the upward pressure on prices has subsided and momentum has temporarily declined. At the moment, however, the RSI is approaching and even touching this falling trend line. This opens the door to a very critical and positive development. The RSI's approach to this trend line is the decisive moment in technical analysis, as a bearish crossover. Because in the past, when the RSI reached this line, it may not have been able to cross upwards and the decline may have continued. But the current technical outlook is quite promising. This time, the RSI has both made a higher low and is trending higher. This suggests that momentum is starting to pick up. If the RSI manages to break this falling trend line, it could signal not only a momentum boost, but also a serious upside in the overall price action. Especially when the RSI breaks such falling trend lines, it's often perceived as a trend reversal signal. Because the RSI indicator is a powerful tool that signals not only overbought and oversold zones, but also trend reversals. We should pay attention to the RSI trend. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.